All right. Hi, my name's Peter Maloff. I am a partner at Davidson Company. I do audits of public companies. A lot of you know me. Before we get started on this, let's get an update on the score. Can we do that? 2-0 Toronto. Excellent. What inning is it? Top of the fifth? All right. So far, so good. Okay. Should I move this up?
You can, yeah.
Hello. Better. Okay, so the big three. Everyone knows about these ones. You know, Bomb, Chuck, and Big Red, if you're a millennial, I guess. Mole, Larry, and Curly. And if you're an accounting geek, financial instruments, revenue, and leases, right? They're all coming up. Now, of course, the ones that are coming up, these are the most pervasive. And when you look at IAS 8, it requires you to disclose the upcoming financial pronouncements that are going to have an impact on your company. You know, maybe some of you don't have revenue, but you're chasing revenue. So, but everyone discloses these. These are the ones that are most prevalent. And sometimes they only disclose these. The other ones are much more obscure. But IAS 3, these are all disclosed. I'm not going to take an accounting pronouncement that took years to negotiate and give you the details of it, but I tried to boil it down into 5 bullet points. How about that? Start with the ones that are effective January 1st, 2018. 3 biggest. They also have the longest lead time for implementation. Right? IFRS 9, financial instruments, is coming at you. It'll replace IAS 39 and other previous versions of IFRS 9, which there are a few out there. And the main topics are classification and measurement, impairment, and hedge accounting. There will be 2 measurement categories for financial assets: amortized cost and fair value. All equity instruments are measured at fair value, and a debt instrument is at amortized costs only if the entity is holding it to collect contractual cash flows, and the cash flows represent principal and interest. Otherwise, it's at fair value through profit and loss. You want me to go into more detail on that? Nobody does, right? Okay, IFRS 15, revenue, also January 1st, 2018. Okay, same, it's been negotiated for years. It establishes a new 5-step model that will apply to revenue earned from a contract with a customer, regardless of the type of industry or revenue. So it tried to catch everybody. Difficult to do. Early adoption is permitted. We did one that they early adopted IFRS 15 because they had better guidance on principal versus agent. So look in there, especially if you're going to start up a new company or you're starting up a new venture. You might as well adopt it now rather than adopting an old standard and then having to go back and redo it. All right, January 1st, 2019, leases. Everyone knows about this one too. All your airplanes are going to have to be recorded on the balance sheet now. Most leases on balance sheet for lessees under a single model, eliminating the distinction between operating and financing leases, right? And the lessor accounting remains largely unchanged, and the distinction between operating and financing leases is retained. Early adoption is permitted on that one too. You got a few years to worry about it. Okay, so these are the ones that are coming up now. Some are in effect. Depends on when your year end started. For beginning on January 1st, 2016, right? These, I'm a bit of an accounting geek. So these, when I look at these are all the boring ones, right? So I'll go through these fairly quickly. IFRS 14 regulatory deferral accounts, it's about for utilities. Maybe if you have a run-of-river project or something like that, it's a whole new standard, effective for January 1st, 2016. IAS 27, equity method and separate financial statements. You can produce a set of financial statements that's not consolidated. So how do you account for the equity investments that you have in it? Using the equity method, right? So these amendments allow entities to use the equity method as described in IAS 28 to account for investments in subsidiaries, joint ventures, and associates in their separate financial statements. The The rules haven't changed. Where the equity method is used, dividends from those investments are recognized as a reduction from the carrying amount of the investment. So it's like the plain old equity method, right? You can do retrospective application on that. IFRS, next one, IFRS 10, 12, and 28, investment entities. Most of you probably heard it. It applies to you or it doesn't. But this tweak, there's an amendment to discuss the application of the investment entities exception, right? Worth a read if it applies to you. Early applications permitted on that too. And then the last one, accounting for acquisitions and joint operations. Very specific. There's amendments to provide specific guidance on accounting for the acquisition in a joint operation that constitutes a business under IFRS 3. If it applies to you, you probably know already. Prospective applications, so if you have a joint venture that's buying other joint ventures, you need to give that a read. Yeah, I like these ones a little better. Still, January 1st, 2016, there's an amendment to IAS 16 and IAS 41, classification of bearer plans, right? I guess there's some companies that are getting back in the agriculture industry that are listed on the venture exchange. This would apply to them, I believe. But so it says bearer plans, as it's common sense. If you have a plant and you sell the fruit, that's IAS 41. That's the agriculture. But the tree isn't. Tree is a capital asset. Sounds simple, right? But this includes the ability to choose between the cost model and the revaluation model for subsequent measurement of that capital asset, right? So this is where I allowed my ADD to take over a little bit, and I decided to look it up. So on a cannabis plant, how many times can you take the buds off of it? I don't know, right? So I thought I'd go to the internet. Okay. I looked it up. I tried to look it up on the internet, right? So, well, it didn't work. So I had blocked here, blocked there, right? Two guys showed up at my door, says, Mr. Maloff, why are you looking up how to grow drugs in your internet connection, right? So I said, So I still don't know. I still don't know how many buds you can get off a cannabis plant. But, you know, if I was a millennial, I'd just text a friend. Agricultural produce grown on bearer plants, for example, fruit growing on a tree, remains within the scope of IAS 41. The next one, IAS 16 and 38, acceptable depreciation. It sounds benign enough, but on this one, the use of a revenue-based amortization method is not appropriate for property, plant, and equipment or intangible assets. So if you're amortizing your assets using a revenue-based method, you can't do that anymore. Now, the guidance for intangible assets includes this thing called a rebuttable presumption. If you come up with a good enough reason, maybe you still can on intangibles. But capital assets, IAS 16, can't do it. It's done. Prospective application. So if you were doing it in the past, you have to change it. Now, there's these other areas of changes to IFRS that are called an annual improvement cycle. And that means that they just clarify the rules that are already there. The rules are there. A lot of people are asking questions, so they go through and say, let's add some explanation. We're not changing the rules, we're just adding some clarity to these rules, right? And they're in 5 areas. I only listed one, but the amendments to IFRS 5, non-current assets held for sale and discontinued operations. I believe that's one to clarify if you change the term of the sale to beyond a year or something like that, but worth a read. IFRS financial instruments, disclosures, employee benefits, and then this one. IAS 34, interim financial reporting. And I'm surprised that no one's asked me in the past about applying this paragraph, right? Because it says that IAS 34, interim financial reporting, that's where you do all your quarterlies, right? Contains a paragraph that states that there is some specific information that shall be included in the interim financial statements. We all know that. Or elsewhere in the interim financial report. So if we only had a regulator in the room that we could ask this, actually, I already asked him if I could pick up. It's part of maybe it's part of a process of making it streamlined, making it more streamlined. But what I'm trying to get at is, in Canada, you have the MD&A and you have the financial statements, and the financials can refer to the MD&A, right? except for that they're separate documents. This is just me, Peter Maloff, speaking, my own opinion, not Davidson Company, but they're separate documents. So the financials can go off on their own. You could give them to somebody, and they refer to a document that the person doesn't have. So you probably couldn't do it for the Canadian ones, but I wonder about the American ones, because although that's not IFRS 34, is it? No, it could be, because that's all part of one document. 10Qs and all that kind of stuff is all part of one. So all the MD&A is part of one document. Why couldn't you, why do you have to repeat stuff, right? So clarification was added in the 2016 to state that disclosures shall give either in the interim financial statements or incorporated by cross-reference to the interim financial statements or some other statements, such as management commentary or risk report. That's available to users of the financial statements on the same terms as the interim financials and at the same time. I don't know if the Canadian ones are. If users of the financial statements do not have access to the information incorporated by cross-reference on the same terms at the same time, the interim financial report is incomplete. So it sounds like a good idea, but I don't know that we could do it. So those are all the ones for 2016. There's a couple here for 2017, and I actually, going through this process of summarizing them, I learned stuff. Hopefully you guys learned one or two things as well. But this next one, IAS 7, Statement of Cash Flows, I love the Statement of Cash Flows. It's my favorite. I think it provides the most information, and what did the company do? I go there first. How active is it? So what's going to happen in January 1st, 2017 is that you're going to have to put another table in your notes referring to the statement of cash flows. And it's so additional disclosure, right? Designed to provide users the ability to evaluate changes and liabilities arising from financing activities. Sounds complicated, but basically it's a table, and you start out with liabilities arising from financing activities. You have some. And then you have the ins and outs and all non-cash, and then you have the next year's liabilities arising from financing obligations, right? Not all your liabilities are from financing obligations. If you have customer deposits or something like that, they're not, right? But there are some, and so that's where you have to provide a reconciliation starting next year. The last one. Income taxes, starting January 1st, 2017. Amendment to IAS 12 to clarify the recognition of a deferred tax asset for unrealized losses. So if you have something you're carrying at fair value, and that's the cost, right, day one, it goes down in value, theoretically you have a deductible temporary difference. Can you recognize it? So there's some clarification that's effective that'll help you decide whether or not you can recognize it as an asset or not. Yeah, that's that. Thanks, guys.